Hello, hi. This is Jerry Mellor here from Trendsignal, a trader education company. This week I'm going to be looking at US equities. We've had some decent inflation data. We've had Thanksgiving out the way, and the markets just keep on rising despite some pretty strong data. And the sort of topic of what I want to talk about today is really what's going on in the equity markets, the sort of signs that things could be running out of steam a little bit, and why investors are so optimistic about what's going on, and the fact that the Fed and the markets can't both be right. But let's have a look. So first of all, I'm just going to have a look at US equities. So what do we mean by a correction? There's a few definitions that analysts use when describing whether markets are in a bull market or a bear market or in a correction. First of all, a bear market is one that is more than 20% off its peak, and a bull market is one that's more than 20% off its low or trough. And a correction is where it's moved 10% either from its peak or trough, and that is called a correction in a bull market or a correction in the bear market. So if we just have a look at what the charts are showing us, I'll just move over to our charts. So what I've got here is a chart of the S&P 500, and we're looking at a weekly chart actually, so each bar represents 1 week. But you can see from the lows in early October that the market has rallied reasonably well. We're up probably about 11 or 12%. I know it's more than 10% because I've done the calculation, but that is indeed what's called a correction. Some participants call it a relief rally in what is still a bear market. A bear market is one that is fallen more than 20% from its peak. So from 4,800, 20%, we're well past, I say we're well past 20%, but we are past 20% when it hit the lows. So we are in a bear market, but we're in a relief rally or correction within that bear market. And this has come about by a number of reasons. Just looking at the daily chart again, one of the big sort of reactions we had at the beginning of the month, on the 10th of November, last month I should say, was this inflation data, which came in weaker than expected. Just one set of data, weaker than expected. We've had a number of sets that have come in stronger than expected, but the market just jumped on this immediately and decided that the Fed, A, wouldn't be raising rates as much as people originally anticipated, and B, it's possible that they could start to cut rates in the fourth quarter next year. And then we have further comments from Jay Powell, the chairman of the Federal Reserve, who said that they would stick to the course, but that they were likely to be slowing the pace of rate rises. And that basically resulted in a further rally. But as you can see, each time we get these rallies, the reaction tends to be, oh, hang on, that's a little bit overdone. And certainly since the most recent comments where the market spiked, the market has been really backing and filling quite a lot. And the reason being, we've had non-farm payroll. Just quickly go back to the calendar, show you the non-farm payroll. Here we go. Stronger than expected on the employment change in November, 263,000 new jobs where 200,000 were forecast, and they revised the previous month's data from October up from 261 to 284,000. And equally alarming as well was the average hourly earnings jump of plus 0.6%, which also feeds through to inflation. There's more earnings, more money can be spent, and it's something that the Fed will be looking at quite closely. And then if I move forward to data this week, we've already had the ISM services data, the Institute of Supply Management Services Purchasing Managers Index. Don't we love those mnemonics? Anyway, it came out a lot stronger than expected. When I say a lot stronger than expected, you might get a difference of maybe 0.5% or 1% occasionally, but this was just way out of court. And it really did result in a big shift in the markets on Monday, with the S&P falling, sort of 70 odd points. So the markets aren't happy with it, But the curious reaction on Friday to the strong non-farm payroll data, the market swooned immediately and then just rallied by the close to finish unchanged. So it's the market just still remains optimistic, and the analysts still believe that the Fed will be cutting rates in the fourth quarter last year, and they still believe that the Fed is likely its path of interest rate rises will not result in a recession. But that's not really what the Fed officials are saying, and so there's quite a lot of contradiction regarding that. So, um, will the markets buckle first, or will the Fed change its tune? I've got a funny feeling that markets might buckle first. But anyway, we've got next week to look forward to. We've got interest rate news from the Federal Reserve next. I think it's next Wednesday. Yeah, the 14th. So Wednesday the 14th, so we'll have the final interest rate decision on the year. And markets at the moment are predicting that the Fed will raise rates by 0.75%. Sorry, 0.5%. It was 0.75% about a month or two ago, but that has definitely softened. So this will be the first half point hike, having had four 0.75% hikes in the previous four meetings. And this is the last meeting of the year. Right, let's move on. So we've dealt with the non-farm employment change and the services data, and I think the only final question is, can the Fed be right and can the market be right? Not really. The likelihood is that markets, I think there's a lot of uncertainty, obviously, with the war in Ukraine carrying on. We're entering winter. We're in the midst of winter now here in the UK. Temperatures are dropping. Gas, oil consumption will tend to, certainly for heating, will tend to rise, and price pressures could resume again. For the time being, I think a lot of analysts believe that inflation is peaking in the fourth quarter, certainly probably this month in December in most of the West. So can it get worse? Of course it can get worse. I think there's a lot of positivity, optimism built into this, and the likelihood is that the outcome might be quite a bit different. I'm not trying to pour cold water on everything, but there's a lot of risk that I think the markets have sort of assumed is not too great, and that's the reason why the markets have done as well as they have done. A lot of uncertainty persists. Let's see what happens anyway. Thanks for listening. Bye now.